Now, when you look at what you put out to investors today, so you're aiming $700 million of cost cuts by 2021. Where's the bulk of the cost cuts coming from?
Yeah, the cost cuts are obviously one part of a much broader plan. What we're really focusing on is getting our returns above 10% by 2021, which we're well on the way to doing. So we spent the last 3 years cleaning up Standard Chartered. It is now a super strong bank. I can't tell you how excited I am to be working there. And I can share this enthusiasm now because I feel like we're through the really hard restructuring that we needed to do to get the bank clean. But we know we have to take the next steps to complete our journey to a 10% plus return. And the cost cuts that you mentioned will be one part of that. But this is $700 million over 3 years in the context of a $10 billion expense base, basically allowing us to continue to fund the pretty substantial investment program that we've had for the past 3 years and that we will continue to have for the years to come. So
is this a new phase? I mean, how do you actually look at it?
We think of this as a
hard part gone, now we can grow.
Yeah, well, I don't know I can say the hard part is gone. The next part's going to be hard as well, but it's a different kind of hard. So what we really needed to do over the past 3 years is clean the bank up, streamline the organization, get it positioned for real growth. Now, we took about $3.2 billion of expenses out over the past 3 years. So the next phase isn't about cost cutting. It's about reshaping the operation for real growth. And that has to do with leveraging our really great demonstrated core strengths with our global international network, which is unique. And it's impossible for someone to replicate. And to focus on our affluent client segment, which is growing. Both these areas are growing at double digits today. These are high returning areas. And they're now representing well over half the bank, having started from well below half the bank. So the objective from here is to continue to grow that good stuff that's been growing fast. And then at the same time, continue to reshape the rest of the organization, eliminate these drags that are still pulling our returns back. So,
Bill Winters, when you talk about growing the good stuff, is this is organically? This is not an acquisition, or could it be an acquisition?
No, this is organic. This is organic. And everything we've done over the past 3 years has been organic. Now, we would never say that we wouldn't look at adding something that just fit neatly into our footprint somehow. But the strategy we've got.
Would it be in wealth management?
It could be in wealth management, although our wealth management product suite is pretty complete right now. And the markets that we cover, we have a pretty good penetration. So it's an organic strategy.
Would you actually merge private bank or fold private bank into wealth management?
So wealth management is we think of it as a product. Private banking is a client segment. So they're high net worth customers. They're managed by the same person. So the interplay between the two is very substantial. But the wealth management products are also distributed through our retail channel. And in fact, about 70% of our wealth products go out through retail. So it's a product group that serves two client segments.
Bill, in the release, when you say we will eliminate residual drags on returns from low-returning markets, including India, Korea, the UAE, and Indonesia, what does that mean? Are you selling off? Are you spinning off?
No.
Are you selling assets?
We identified about 20 markets that are in this bucket where we are a local bank. It's also part of our strong global network, but we're not fully scaled in the local operation. So typically not fully scaled in retail. And we gave 4 examples, which were Korea, India, Indonesia, and the UAE, where we have a super network business in these markets. We have a good, trusted local business, but it's not generating adequate profits. And we're going to, in this next stage of our restructuring, we're focusing on what can we do to get those businesses up above cost of capital together with the rest of our bank.
And so it's almost the reverse of cutting back on them.
Well, in some cases we'll be investing, but we will be attacking costs in these markets. We'll be attacking trapped capital that we have in these markets. We'll be looking at, very importantly, looking at ways that we can partner with tech companies or e-commerce companies in those markets to take our relatively small-scale retail businesses and plug them into a much broader reaching e-commerce network to deliver our products to many more clients and to do that with superior analytics.
Do you feel like it's been difficult to keep costs down?
Well, it's been a challenge to get $3.2 billion of expenses out of a $10 billion expense base. We've had to work really hard at that, but we have. We are much more efficient than we were 3 years ago. We're shifting our focus now really to productivity. So it's not about stripping out fat or simply streamlining the organization, because we've done those things. The next stage is to substantially re-engineer our processes to get a lower cost of production, a lower cost per unit of transaction, a higher income per client.
And is that also why you're moving actually some employees, and this is how I read it, but correct me if I'm wrong, full-time employees concentration, reducing that from high-cost hub location. So are you moving them out of London?
Well, we're a funny bank in that we have a headquarters in London. We have an operational headquarters in Singapore. We have a very important regional hub in Hong Kong, our biggest region, and in Dubai. And then meaningful operations in 60 other countries around the world. So we've accumulated a cost base in some of these high cost locations, Hong Kong, Singapore, London, New York. And what we will look to do is to effectively cycle the headcount from these high cost locations into other lower cost locations in our network at the same time as we know.
But is it job losses or is it moving people out?
No, I think it's more likely to be a rotation around. So for example, in Singapore, we've moved substantial numbers of people or functions out of Singapore into places like Bangalore or Kuala Lumpur over the past 5 or 6 years. But our headcount in Singapore has continued to go up. And it goes up because we've got other things that we really want to do closer to our operational hub. But what we need to do is to take functions that can be done in lower cost locations and put them in those lower cost locations.
Bill Winters, how much pressure do you get from major investors, including Temasek, to actually have better returns?
Yeah, the way I figure it is that the pressure that we put on ourselves is at least as great, if not greater, than the pressure that we get from any shareholder. We're very impatient at Standard Chartered. I know Andy Halford, Jose Viñals, my partners in this odyssey, are singularly focused on getting our returns up above 10% sooner rather than later. We've got a good plan to do that over the next 3 years. I think Temasek is supportive of that plan. They want to see us get there, and so do we.
What is the one thing that you would need from the world economy to feel better, actually? Is it the U.S.-China trade relationship? Is it, a comeback from emerging markets?
Yeah. We know that we have a number of businesses that are very market sensitive. So our wealth management business, for example, definitely goes up and down with the sentiment in global markets. So we had a more difficult fourth quarter in wealth management, I think like many on the street, where we started 2019 on a solid footing as markets have begun to recover. So we can't wish for better markets. I mean, better markets would make life easier, but you can't have better markets forever. We know that's going to be up and down. In fact, what we've told our team is there are no excuses to not hit these targets that we've set. Good economy, bad economy, trade tensions, no trade tensions. We have the potential to get to this cost of capital plus return, and that's what we're going to do.
Bill Winters, there's so much speculation about M&A, about you merging with someone, either a UK rival or somewhere else. Is there going to be a consolidation phase in your industry, and what role will you be in it?
Yeah, it's not necessary for us, and that's the good news. So our strategy is premised on taking what we've got and going from okay to great. It's not necessary for us to achieve either substantially higher scale or to fill in parts of our network. That said, there will be consolidation in the European banking industry. And we're obviously a little bit more anchored in Asia, the Middle East, and Africa. But there's a surplus of capacity in Europe. And there's probably some consolidation over a period of time to happen in Asia as well. And perhaps we can play a role in that as we regain our own financial footing and have a position that would put us in a better position to be the acquirer. But there's no consideration from our side in needing to be part of a consolidation.